Welcome to the Tesla Economist. Please hit the thumbs up and remember to subscribe. You can follow me on Twitter and talk to me on Patreon. We knew this Q2 wasn't going to be great. I think I was saying that probably back a year ago. It was obvious given that Tesla have two huge new large facilities that will have low capacity to start with, yet high costs, that would eat away at margins. We were prepared for this, and so was the stock price. Well, we were prepared for some of it. However, wars, crazy oil prices, inflation, and a recession weren't quite factored in. I mean, the stock had always priced in this ramp-up period. It went without saying. In fact, if Berlin or Austin hadn't even been built today, I'm not sure how different the stock price would even be. There's a lot of value from those two fabs still to come. But now the economy is taking the limelight, as at the end of the day, the macro still has ultimate control, although Elon's actions are still able to stir things up. Personally, I do not like the look of the economy. I don't believe the Fed has a large enough arsenal to fix inflation. At this stage, I just hope things transition peacefully, but I'm still expecting more inflation to come. Either way, we have a lot of economic instability ahead. Economists cannot predict the economic future. This is often supported with the rhetoric that economists have predicted 7 of the last 3 recessions. But this time, the writing looks like it's on the wall. Or Wall Street, perhaps. There is a recession ahead. We just don't know how the markets will react. We don't even know what will crash. It could be the markets, or even currencies. In uncertain times, it makes it harder for consumers to purchase expensive items, which is why I've mentioned it may be beneficial for Tesla to explain just how much cost saving is associated with a Tesla compared to an equivalent ICE. Remember, when you buy electric, although the price tag may be higher, it includes all the fuel and servicing costs. Therefore, the actual sticker price is disproportionately higher from the cost of ownership compared to ICE vehicles. Our saving grace during a recession is the fact that Teslas are coveted so much by consumers, the demand will remain strong, or at least much stronger than the competition. Now, when it comes to predicting the financials for Q2, Austin is going to be tough. In fact, if any of you have any idea on how to treat this, then let me know in the comments. The scenario is that Tesla have been delivering cars from Texas this quarter. They started delivering to employees and are now opening up to the Austin area. Therefore, does that mean that we have to incur the running cost of this building the entire quarter, despite what is likely to be just a few hundred deliveries from the factory for the entire quarter? This factory is going to produce some Lucid type numbers. Well, maybe not quite that bad, but it does have the potential to really hurt profits further. Berlin has been operational through this entire Q2, so we're definitely going to feel the full costs of running that fab. Unfortunately, their production rate has not been close to producing the profits we need to contribute to these costs. Therefore, we will need to incur all this additional expense. The Model Y Performance they're selling there will at least have a very good margin, or will do when the lines are functioning better. Therefore, we'll see a reasonable loss in Berlin as well. Somehow I have to try and calculate the cost of running that fab for a quarter too. And as we're in such a liquidity crisis, well, people have had to sell their crypto. Even Bitcoin took a huge hit. So much so that it's going to leave an impairment on the financials. Yup, another Bitcoin loss this quarter to top it all off. Ironically, the intention for Tesla's Bitcoin purchase was a hedge against inflation. And further irony, it feels like the best hedge for inflation is having cash. In down economies, the US dollar tends to strengthen as people see more stability in the dollar as it's the world currency. Well, Tesla is an American company, valued in US dollars. The Teslas that are sold overseas are sold in local currencies. These local currencies are now worth less. Yes, even the yuan has dropped 7% against the dollar. Therefore, this is less overseas income, although Tesla may have hedged the US dollar. At least Tesla produced locally too, so unlike other US exporters, Tesla's costs are coming down equally, and thus keeping margins intact. Of course, we can't discuss how much Tesla is struggling this quarter without talking about Shanghai. This is what has really worsened Q2. The fact that on top of all of this, Shanghai enters more COVID lockdowns. Even in this day and age, the CCP still insist on a zero policy lockdown, or who really knows what they're playing at. As a result, Tesla only managed to produce about 10,000 units in April from Shanghai, yet managed to get back to 80% capacity from the lockdown in less than 2 weeks. This is very impressive ramping back up, especially at the run rates we see in Shanghai, but then went from lockdown issues to parts shortages, meaning that now they're still only back at about half capacity. We have been told that Tesla does have a target to get to 2,600 vehicles a day in Shanghai. Hopefully they can get there soon, as that is a run rate of 80,000 vehicles a month. I know it sucks that we lose a lot of production in Shanghai, but the fact that Tesla are able to hit 2,600 vehicles a day more than makes up for it. And you know what? I bet they can beat that too. Sure, Shanghai will hurt Q2, but hopefully make up for it in Q3 with perhaps as many as 250,000 deliveries. Well, you might be happy to know that I can't think of anything negative to say about Fremont in Q2. There are a lot of people reporting more activity than usual coming out of there. Hopefully the S&X lines are ramped up a bit more. But unfortunately, Fremont isn't going to have much impact on the company this quarter, one way or another. Fremont's margins may even be up a little bit higher due to importing with a stronger dollar. For example, Tesla are now saving about 7% on importing CATL's LFP cells that are used in the Fremont Model 3 standard range. Of course, it's not just Tesla going through bad times and the economy making it that much harder, it's also Elon's antics on top of that. Mainly I'm referring to his distraction with Twitter. Oh, right, and selling billions of dollars of Tesla shares in order to do so. This does not help the Q2 Tesla stock price either. There are a lot of investors unhappy about Elon's Twitter involvements. I've expressed my thoughts on it, and ultimately I don't think it should impact Tesla negatively. Perhaps it can even become an advertising medium for Tesla. Demand does seem to be very strong still, likely getting stronger, which is the main concern in a down market, when no one wants to buy or can afford to buy your products anymore. But perhaps Tesla is such a unicorn it can fight the grain, similar to Apple after the global financial crisis. I'm not sure Tesla's demand is fully appreciated enough, and just what a buffer it may be in getting through tough economic times. And equally add into that Tesla's massive margins. And what are margins, if not extra demand buffer? That's right, margin is deferred demand. If Tesla reduces margin, it increases demand. I know we talked about Texas already, but it does more than make vehicles. There is the battery cell factory there too. Things haven't been going great there either. I mean, I'm not saying it's bad necessarily, I'm just saying we haven't had any great news to help us out during this dark time. There could have been some good news to come out of here that could have propped up the stock price. Instead, no news and rampant speculation. Sorry if this sounds like some sort of doom and gloom Q2, it's not intended to be. We knew it would be bad, so we prepare for it as best as possible, so that if we do see another big drop, we were ready and able to act accordingly and rationally, rather than emotionally. Also, the reason for most of this Q2 are temporary reasons that will be sorted. We just need to hold our breath through them. I just wanted to go through some of the major issues we're facing so we can relate it to the stock price and perhaps judge from there how much of this may be alleviated and when. In fact, when I list all these issues we're incurring right now, all at once in this concentrated period, it makes you think the stock is actually holding up reasonably well. Even elements of the almighty FANG have fallen. Once you get through this and come out the other side, you'll be a stronger Tesla investor for it. It may be a lot easier to say than do, but don't get emotional about money when it comes to investing. You may not always buy at the bottom, but the important thing is to ride it to the top. We may see issues of some sort for a lot of next year too, but I really hope to see some blue sky after that. What this company is capable of when there aren't any major issues will be amazing. If I recall, when Tesla introduced the Model Y, it was actually a time when Tesla wasn't facing any major issues. The Model Y ended up being released months early to the public. Sometimes Tesla really can pull rabbits out of hats. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.